Hello, ladies and gentlemen. Good morning, good evening, depending on what part of the world you're in. Maybe you're watching this at night, maybe you're watching it in the morning with your morning coffee. Thank you for watching. And today we're going to be basically answering the question, bounce or dead cat bounce. So are we going to get a true bounce? Are we going to get the dead cat proverbial bounce? And I did hint at this in the weekend deep dive, link down in the description below if you guys did miss that. But for those that do not have a lot of time, I'm going to try to be as concise to the point as quickly as possible and give you the too long didn't read version first. So if we go to the S&P, here's the too long didn't read version. We basically caught the bounce I was talking about the weekend. I said that this area where this gap actually comes in would be an area I'd be looking for that rotation around the 444.91 mark. We came down to the low of the day at 445.27, so around that 445 like we were talking about on the weekend. Then we got the bounce, we rotated back up, closed above where we opened, so now we're starting to get that bullish rotation. Volume wasn't anemic, but it wasn't also great. So some of the things that are catalyzing us to the low side today was that Moody's cut the rating of 10 US banks, mainly mid and small tier. However, they did put some on watch. Watch basically means, like similar to how PacWest was, that hey, we're looking at possibly downgrading you. You have to provide evidence of why we shouldn't downgrade you. And one of those bigger banks that's on the chopping block is US Bancorp, the 7th largest bank in the United States. So again, if US Bancorp gets a downgrade, that would pretty much spell disaster for the financial sector, reigniting the SVB FRC fears. And as we can see, the financial sector took a nice beating today. Well, KRE did rotate back up above, so you had some risk taking there. XLF was down on the day, however, rotating back up. So you still have that bullishness in the market. You still have that sentiment of bulls in the market coming back and defending it. And remember, we still haven't seen the third leg of this capitulation of the bears. The bears, if this is a true bull market, need to capitulate in this region, go down, pick another leg up. That's your third leg. Remember, there's 3 legs in this, similar to back here. 1, 2, and then 3 capitulate. You have 1, 2, and technically you don't have 3 yet. So we need to see them come in, short the market, and basically run us to all-time highs. If you're bullish on the market, if you're bearish on the market, well, it's pretty hard to be bearish because your team's not actually winning, where we are defending the lows. You're making a lower low, but you're not holding it. So it's considered a failed breakdown. Every time we've seen these failed breakdowns, they result in this big, long rally. And it's pretty bearish in the sense of you're going down. You've gone down 1, 2, 3, 4, 5, 6, 7 days now. So you're pretty much getting towards that extent where this bearishness is starting to weigh off. You haven't even got down to the 50. So it's a pretty pathetic sell-off if you're in team bear, and it's not what you necessarily want to see. If you're in team bull, congrats, you basically bought the dip. You bought the dip probably all the way down, and right now you're pretty much getting rewarded about 25% of the way. And what do we know? That the bull team comes back and rescues its own. It always comes back, as we've seen time and time again here, rescuing its own. The NASDAQ actually had a hammer style candle on the day. It rotated below, came close to the 50, pierced below this gap. So I was saying that if we start piercing below this gap, I'd be looking more bearish. Now, you failed to close it. And I was talking about this on the weekend deep dive, that you failed to close above or below this price. So right now you're closing above 371.53, which was the rotation to the downside. So now what do I expect? I expect 1, the gap, and we have a new gap today, guys, on the NASDAQ. We have this gap right here that we're going to fill. Most likely going to fill tonight. Going into tomorrow, we're going to basically open somewhere here, kind of pierce down, maybe finish out closing the gap, or we just may gap and go tomorrow. I don't expect more bearish continuation right now, or at least there's not any evidence there yet. The bulls are still in charge. Case in point, fear and greed, ticking right back up to 70. We were at one point at 64 during the day that I saw briefly, but then we ticked right back to 70. So greed is still well and alive in this market, and it just shows by the style of candle that we got. We basically got down day and push back up. So let's see game plan for tomorrow. Rotate up, depending where we open. If we open anywhere close to this candle right here, I'm going to see that rotation to the upside where you're going to come above this price point of 375. That's going to be important. Break 375, then you start rotating, trying to tackle these upper consolidations here at 378, and then the gap fill starting at the 379 point. Again, what do I mention on this channel all the time? Volume and price need to confirm. So volume's going down, prices going down. That's not what I want to see. I want to see volume ramping, then price going back up. I don't want to see lower selling volume going as the day progresses. Now, the bullish days have less volume. I'll give the bears that. However, you're not really having a bearish trend necessarily. You're barely making this market go down. Once you got the initial leg, you only are down 2.4%, where the bulls have basically pushed you a whopping probably 30-40% on the year. So you didn't even make it down to the 50 DMA. So do I really look at this and say bullish or bearish? Now, I still have my long-term bearish thesis, guys. That's still in play. Some of the stuff that's going on in the banking sector is, and I'm heeding the warning of Warren Buffett that another leg is set to drop. And we just see that. We get more and more carnage out of the banking sector, but everyone is ignoring it. So if you believe in the rainbow rosy version that Jerome Powell is going to soft land this market, I got an island in the Bahamas to possibly sell you. So again, before I digress into that, it's bullish short term. That's how I would play this. I would play this into CPI tomorrow, basically bullish. Now, would I play CPI bullish? Well, that's where the elephant in the room comes in. So if we jump over to the CPI expectations, and they actually finally posted these expectations, we can clearly see that we're basically expecting core to stay flat. Not a lot of progress there, but still a decrease. So the bulls, I think, are going to cheer that. The month over month is stalling out. However, what's interesting is the CPI year over year, even though oil prices are going back up. If you haven't checked your gas prices recently, I highly recommend you do that because, well, you may have a heart attack when you see them. But right now, I don't see a lot of progress on inflation from oil causing inflation go up if expecting 3.3. That is a pretty massive, or their lack thereof, increase when oil's basically up 20% for the month, and gas and energy is not really driving that CPI metric. So the question is, do we expect shelter and food inflation to come down, or have these hopium bulls that I call the CPI, have they been snorting their own stuff and they can't realize that oil is going to drive a bigger percentage in this inflation report and possibly cause this 3.3 number to get beaten if we come out at 3.5 or 3.6? Throw it down in the comments section what you guys think, and if you wouldn't mind hitting the like button to help us get out of YouTube jail, because YouTube basically put us in the penalty box, and it really would appreciate you guys hitting the like button. It really helps us out. But looking at this, the question that I have for everyone out there, if you're bull or bear, undecided in the market, why would you trifle in this crazy kangaroo market? Yes, you can get a higher percentage, but I can come over here, and for those that don't necessarily have all the time in the world, I can go to a 3-month bond paying 5.5%. And historically, the market doesn't return more than 10 to 14%. You're at like 20 something right now. So maybe squeeze another 5%, which is like the historical upper range of what those extremes are. Or I can just come here and get my guaranteed 5% and stop chasing this crazy market. To me and my risk appetite, I'm going to stick with bonds because they're just a simpler trade. I know the percentage I'm going to get on a year over year, and I know how much I'm going to get paid out from now to the end of the year. I can rotate my money in 3 months. Until the Fed starts cutting rates, I'm basically going to have a guaranteed return, which there's very few things in life that are guaranteed. So why don't we take that? Why don't we take the opportunity to basically say, yeah, I'm going to take this free return versus trying to play the kangaroo where I'm up to 2% one day, down 1% the next day. It's just, to me, it's not a very enticing argument to basically go into the SPY or go into tech and say, hey, I'm going to go through this kangaroo. You could be having a momentary left shoulder, head, right shoulder forming, but I really don't subscribe to that theory right now. And we really haven't got a true 50 DMA test. So again, is it one of these crazy runs that are basically causing us, as we go back here, we haven't really had a true 50 DMA test, but the bulls really haven't given a crap about it. They just keep pumping this market up. And like I preach on this channel all the time, is prices going down, volumes going down. That's not a good thing. You want to see volume ramping as prices moving in the direction that you want. This is an indication of a reversal, especially if you look at Apple. Apple stopped going down. What's the first criteria to basically change your trend. One, stop doing the trend. So Apple stopped going down. It closed green. It made a higher low. So this is the first sign that after Apple's earnings that, hey, maybe this is your pullback. Maybe this is your massive A to B pattern, which hypothetically, right, if we play this Apple pattern out, A to B, B to C, projecting up to $232, that would be an insane evaluation, driving the market absolutely bonkers higher. And I do think that you could get a dead cat bounce up to the 50 DMA, kind of double topping on this gap fill, and then rotating back down on Apple. But again, let me beat this into the bears' heads. Short term, we're most likely bullish. Stop trying to short the market when the trend is showing you that it's bullish, guys. Like, I can't beat that into everyone's head further enough. If we go into Lux Algo just to beat it into everyone's head even more, we are starting to, on the smart money float, to kind of pinch together. You're showing signs of a possible reversal. If we go to the 4 hour, we can clearly see here, if I take the regular trading hours only, we already got the reversal signal and buy signal to the rotation to the upside. So it's very shortly coming that we're most likely going to get that rotation to the upside on the S&P. And just to show this clearly, we do possibly have an A to B pattern, B to C on the way up, projecting us up to 467.65. So again, we have to get above a large swing point to get back up there, but it is very, very possible. So again, don't try to short a market that basically has gone 7 days straight down. It's just a bad idea in my opinion. But then again, do what you guys want. It's your money. I don't decide that for you. But to me, you missed the boat on the short. Maybe play the upside because, you know, that FOMO mentality of, hey, I missed the short, I need to get in, the market's going to collapse, and then the market basically runs up and takes your money. Maybe listen to the opposite of what you're saying. I've done that before. I've made money. And right now, what I'm seeing is I want to short the market because I've been so skewed to short the market. However, fear and greed is at 70. I need to be greedy. I need to be playing the market to the upside, especially with the big names showing strength again. Now, going into CPI, would I take a larger position? No. But again, CPI could come in right at 3, meaning that you have either shelter or something else like food start coming down and could calm that oil inflation. Or they may just pick and choose the numbers as they choose and skew the numbers to be less. So again, keep your eye on that. Again, one day is not going to kill you. And especially, it's going to be a pretty easy close setup tomorrow. If, in my opinion, if we're trending up into this 453 area, I'd be looking more short side. If we're trending downwards into CPI, I'd be looking more bullish side. That's just my opinion. I'm going to play the countervailing point, however, into CPI, and we go from there. Or I may decide not to play it. So hopefully this gave you enough info that you can see what you should do, what you shouldn't do, and basically kind of give you a countervailing point to maybe some of the assumptions you may had, so you can challenge it and maybe see, hey, are my assumptions right? Maybe I'm wrong. You know, just a different point of thinking. So I thank you very much for watching, and I hope you guys stay tuned for our next video tomorrow. And of course, we'll be live streaming the CPI report, so you guys can stop in for that. So we hope to see you then. And if not, I hope to see you on the weekend deep dive, and throw a comment down below on the way out. It really helps us interact with you guys and know what you guys want. So thank you very much for watching to the end, and I hope you have a wonderful day.